You may be familiar with the term time in the market over timing the market. The idea is that we're not going to time everything perfectly in the stock market. This is why we don't just liquidate holdings when times get tough. Instead, we stay invested through thick and thin. We adapt to the changing economic landscape. Moreover, we capitalize on volatility to increase gains and improve portfolio performance even when the market turns sideways or heads south like it did recently. Of course, we may want to be a bit more active and somewhat more selective during this heightened period of volatility. Adjusting positions around critical peaks and troughs is also very important here. In fact, it's typically around these crucial periods of increased uncertainty that we can get the best deals in stocks. Historically, the people who have the vision and the fortitude to add to high quality positions on market weakness, they end up reaping the greatest rewards in the end. So, there's a very active bull versus bear debate, especially since we had the huge drop in the markets and then we had, the massive rebound. So the debate is very active. So in a bull market, stocks predominantly increase in value. Aside from those periods, when we have pullbacks and corrections. But typically, these are just short-term dips in the market, and they occur when the sentiment or the confidence in the market suddenly becomes negative. Now, in a bear market, the opposite thing occurs. The predominantly negative sentiment, it pushes stock prices lower. So we're basically seeing mostly downward pressure on stocks, aside from some periods with major relief rallies. So one theory here is that, we're in a bear market and we're experiencing a major counter trend relief rally, and it may stall and we could have a more significant pullback ahead, or in a worst case scenario, we could even see a retest of the prior lows around 5,000 to 4,800 S&P. I think that there may only be about a 15 to 20% probability that we see a lower low ahead. So basically, it's all about sentiment. When the market is well, sentiment is mostly favorable, which increases demand for high-quality risk assets, enabling many stocks to move higher. On the flip side, when the sentiment is poor, the market, it's in a sad place, decreasing demand for risk assets, causing multiples to contract and stock prices to crater. Now let's look at the VIX one-year chart here. Very, very interesting. Before April 2nd, it was evident that this was just a correction. However, volatility surged after the tariff tantrum occurred, and the stock market took a serious nosedive. The VIX skyrocketed to around 50, registering one of its highest readings. We've also seen general volatility picking up over the last year as we witnessed numerous VIX spikes to the 20 to 30 level, which is a very atypical trend for a healthy bull market. Let's be honest here. And also, I want to highlight that this VIX surge recently, the VIX shot up to about 50 or around 60 even. And while I just want to point out that while we did have a similar spike during the August sell-off, this VIX spike was more severe. So it really was one of the most significant VIX spikes that we've seen in many years, because we can only compare this magnitude to maybe the COVID lows and the highs that we saw during the Great Recession. I don't recall the VIX ever exploding with this power and this magnitude aside from those instances. So preferably we would see the VIX mostly confined to around the 10 to 15 range, with the rare pop to around the 20-25 level in a pullback or in a correction scenario. Now, the elevated volatility dynamic may be related to macroeconomic restructuring coupled with relatively high valuations in recent quarters. And maybe there is such a thing as too much change too quickly, as we're seeing in regards to the White House and everything that is being implemented now. We have essentially seen a three-part sell-off in the S&P 500 and in most other major stock market averages. So the troubles began around the end of last year when the market had a significant sell-off in mid-December following the Fed's hawkish rate cut projections. Around this time, the market realized that the Fed could only cut 1 or 2 times in 2025. Despite the previous expectations for 3 to 5 rate cuts. The sell-off led to a mini pullback process, after which the market went on to make new highs. However, despite the market making new all-time highs, the volatility persisted into the new year, with the DeepSeek and other sell-offs occurring throughout January and February. So, I mean, we just saw all these triggers: DeepSeek, poor earnings guidance from some companies, adjustments, and just very high valuation. So basically, we saw a lot of triggers that caused the correction to happen. Consumer sentiment worsening around late February. This dynamic led us to the second part of the sell-off, which occurred in late February. The market received troubling news of considerably worse than expected consumer sentiment at this point, and we began seeing potential signs of an economic slowdown, so more concrete signs. This dynamic and the uncertainty regarding the future of tariff policy caused the pre-Liberation Day sell-off to occur. So, I mean, we saw a big leg down there. And of course, the third and most brutal leg of the sell-off occurred due to the shock of the sweeping tariffs announced on April 2nd. After this, we witnessed the most significant three-day market cap drop in stock market history, which brought us to this panic-driven bottom on April 7th. So now the trillion-dollar question remains: was this three-part sell-off just a grisly correction, or is this the beginning of a bear market instead? Now, some people classify a bear market by a 20% plus drop in a major market average, like the S&P 500. So let's take a look at the futures chart here. From peak to trough, the S&P futures declined by about 22%. Technically, this pushes the S&P 500 into a bear market. Now, an interesting stat is that the S&P recovered about 18 or 19% already from its April 7th low. So we're approaching that 20% mark. We're just basically just shy of that new bull market starting. So let's take a look at the NASDAQ 100 futures. The example of the NASDAQ and tech stocks is even more extreme than the S&P 500. The NASDAQ 100 futures topped out at approximately 22.45 thousand late last year. Then we witnessed a double top develop around the end of February, so this was major. On April 7th, NASDAQ futures touched down on around 16.5 thousand. This represented a staggering 27% loss in a very short time frame, making one of the sharpest declines in stock market history. Also, the NASDAQ 100 has gained about 23% from its low. So does this dynamic imply that we went through a brief bear market and we are now in a new bull market for tech stocks? Now let's talk about time in the market. The strategy should remain to purchase high quality stocks with an emphasis on the intermediate and long-term horizon. I bought the dip around the bottom on April 7th. I bought the dip on April 10th. I also reduced some positions that skyrocketed in recent sessions, and I plan to dollar cost average on further weakness ahead. So despite being more active due to the increased volatility, my general investment strategy remains essentially the same. I will remain invested in high quality stocks. I will reduce around high periods of euphoria, and I will increase my positions on pullbacks, on further dips during this correction process or bear market, whatever you want to call it. But the point is, I will increase my positions during extreme lows, and I will reduce some positions when the market rallies in this environment. And, of course, adjusting and diversifying and and rotating these all remain key elements here right now. So I am long America here. I believe in the future of America. If I like Tesla stock at 300 and at 400, I'm going to like it even more at 200 and 250. So if I liked AMD around 120 and 150, then it makes sense to buy AMD around 80 or 90 because I believe it's going back to 120, 150, and then to 200. So we could actually even see a reacceleration of AI growth once the economic atmosphere normalizes. When the bull market was very healthy, we could just invest in stocks ABC, and we could watch them appreciate relatively steadily, and that would be great. Now it's a little bit different. Nonetheless, the market, it remains a forward-looking mechanism. So it may be it's like looking ahead by about 6 months at any given time. So if you're waiting for an economic period when everything is fine and it's everything is going well, good luck looking for such a period. Another thing is that by the time you invest, in many stocks, they're going to be 50 to 100% higher off their bottoms, because the best time to buy stocks is during periods of extreme volatility, panic selling, and turmoil. You're simply not going to see that when everything is fine and dandy with the market and with the economy. So think back to any significant sell-off period, whether it's the bear market of 2008 and high-quality banks and many other stocks traded for pennies on the dollar, in late 2008 and early 2009. 2011 period brought many excellent buying opportunities. Netflix was selling for pennies back then, I remember very clearly. We also saw a period when oil went negative. Who would have ever thought that oil could trade at negative $37? Nonetheless, it did during the COVID crisis. That was incredible. Then there's the 2022 tech meltdown, just to have a stellar rise in 2023 and 2024. So again, we see the best opportunities during times of economic weakness, and this may be another such time now. So given all this, I just want to emphasize that again, it's all about time in the market, and the best thing we can do in most cases is dollar cost average. On the other side of the equation, we want to reduce some positions after the parabolic moves, especially during a down market phase like we're seeing currently. So we've seen a lot of appreciation in many of these stocks. Like the S&P has moved up by about 20%, but we've seen many stocks move up by 50 or 100% during this recovery process. So I'm just, I've taken a little bit of profits, I've trimmed them along the way. I'm taking a little bit more now. I'm hedging a little more. So I think, in the near term, we could be getting a little bit more defensive here. Let's talk about earnings. Earnings look solid, but the uncertainty, it remains. So we've had solid earnings from most companies with about 75 to 80% sales and EPS beat rate from most bellwether firms, which is what we want to see here. Notably, Microsoft, Meta Platforms, and others reported better than anticipated earnings and guidance, also illustrating that the AI growth remains solid. The bottom line is that while I remain bullish in the intermediate and long term, there are more near-term issues in the market. Are we going into a recession? Are we in a recession? These are great questions, and whether the economy will avoid a recession is not clear now. We could still see a soft landing in a bullish case scenario. However, this outcome could require timely trade deals, and we need the Fed to cut in time also. If the Fed is late to the party, it may not save the economy from going into a recession, which is a major risk here. In a base case, we could see an earnings slowdown in future quarters. Now, the crucial question is whether the market will choose to look past the slowdown phase. If the market prices in a bullish 2026 and a limited slowdown in 2025, the lows could have been put in on April 7th. We should also consider the potential for future tax cuts, deregulation, fiscal stimulus, and other potentially bullish variables. Therefore, I remain constructive on markets and the S&P 500 despite the potential for more near-term volatility. I am keeping my 2025 year-end S&P 500 target range at 63 to 6,500. So I thank you for watching my video. I hope that you enjoyed my profit report, and more importantly, I hope that it helps you make more informed decisions going forward. I would also like to hear your comments, so please join the conversation in the comment section below. If you like this video, please click like, share, and subscribe to my channel so I can continue making these videos for you guys. You can also join the Financial Profit, my exclusive investment community, which is seeking alpha's #1 service for proven portfolio profits. Thank you very much for watching. I hope that you benefited from watching my video. See you next time, and have a wonderful day.